The Dallas Fed economists now admit that we are in a housing bubble and are predicting that we're going to see a 19.5% housing market crash. On top of that, according to the Atlanta Fed affordability chart, the housing market affordability is worse than it was at the peak of 2008. And with the Dallas Fed admitting this, what will this do to the American people and their outlook on the housing market? A matter of fact, we haven't seen the U.S. housing market this unaffordable since 2006. And according to this article from Globalists, Blackstone REIT is still bleeding money. They have around $3.9 billion of redemption requests, but they've only been able to fulfill $1.4 billion worth. Not only are REITs suffering from people withdrawing, but so are banks. 2022, according to the Wall Street Journal, the banking industry profits fell 6%, with many banking executives preparing for the Americans to fall behind on their mortgages and their loans in 2023. As of March 1st, the 10-year Treasury topped over 4%, just like what we saw in May of 2022. In just 30 days, we saw a 1% interest rate jump. And in this video, we're going to jump into all these things and more. We normally don't go into the state of the car market, but I think it's important that we review the debt in totality, especially since the report is stating that the percentage of borrowers who are at least 60 days late or more is higher today than it was at the peak of the Great Recession in 2009. The percentage of the subprime auto borrowers who are at least 60 days late on their bills hit 5.6% in December, surpassing 5.4% in January of 2009, at the peak of the Great Recession. The director of Insight for Edmunds, Ivan Dury, said, "We are only seeing the tip of the iceberg." Now think about this for a minute. If you're struggling to pay debts, what are you going to default on first? Your home or your car? I know a lot of you know this, but I want you to think about something. If unaffordability hasn't been this high since 2006, what happened just 2 years later? If defaults on car loans haven't been this high since 2009, what was going on during that time? You see, I think a lot of investors and smart Americans like you who subscribe to this channel are seeing what's going on, and that's why they're trying to liquidate and get their cash ready. And speaking of people being 60 days late or more on their car payments, some of you guys are late on subscribing to this video. Take a second, subscribe, and let's get back into it. Even Blackstone, which is a private held REIT, is saying that they're trying to stay liquid while capping investors' withdrawals because they believe that there's going to be ample opportunities and they want to be able to be on the offense and not the defense. Being on the offense, don't get emotional and stay data driven. Let's see how this correlates with what the Dallas Fed said in their latest report, where they believe we are in a bubble and need to see a 19.5% drop in the home prices. In this article, they talk about the concern of investors pulling out of the housing sector and liquidating and putting money into safer assets. Then the question is, what is the lag effect or the domino effect from these liquidations? You see, Blackstone isn't the only REIT limiting withdrawals. You see, KKR, Starwood, UBS, Turnbull, and more are all limiting withdrawals because their investors are pulling their money out of these REITs. And if these REITs, who have helped a lot of the mass inflation on home values, are struggling with liquidating their assets, what is this going to do to the inventory levels? And I know what some of you are thinking. All these REITs don't just buy residential multifamily units, which is correct, but they are preparing for something bigger than what we've already seen. And my question is, are you? Now, something else that this Dallas Fed article said that was very interesting, and we can see by looking at this graph, is the 19.5% overinflated housing sector is not the highest that we've seen. In fact, the 2008 bubble was even higher. According to this chart, the price to rent ratio started climbing in 1998 and peaked about 2006. Then it came back down till about 2011, 2012. But now we see the increase from 2020, and it peaked in just 2 years. So a sharp incline and a potential sharper decline, that's just the way that I'm interpreting this. But what do you think this is going to do to the economy as a whole? See, the Dallas Fed hopes price to rent ratio back down to the 2020 levels. And what do you think they're trying to communicate? Now, let's see what they've been seeing and believing is causing this housing bubble. According to them, I quote, "A housing boom becomes frothy and out of sync with fundamentals when driving by fear of missing out, or FOMO, as we've talked about. And based on the wide acceptance of the belief that today's strong price appreciation will continue unabated in the future, leaving behind prospective purchasers," which is what we saw here in Boise. And we currently see some agents, lenders, and people trying to create that now. They're trying to create this FOMO that we saw in 2020 and 2021 at the beginning of 2022. They're trying to leave out the basic fundamentals of real estate. You see, if you buy now and you're only putting the minimal payment down, then and we see another down 10% drop, you will lose the opportunity to refinance without having to bring some kind of money to the table. You see, there are tools that we're not going to talk about the streamlined refinances for VA and FHA. We aren't going to go into that here. For the most part, people are going to have to bring money to the table if they buy now and are planning to refinance later if we continue to see these declines. I've heard it said, you can always refinance a rate, but you cannot change the purchase price. If you buy something $100,000 over value, you cannot just change that purchase price, but you can refinance on a higher rate. Let's jump into this affordability graph by Atlanta Fed. According to this graph, and we're going to have the link in the description if you want to play with it for your specific city, but I'm going to look at the national and then the Boise City here in Idaho. So nationally, the affordability, people who have to buy a house right now are spending about 43% of their income in order to pay for the median sales price nationwide. But here in Boise, it's 48.5%. And this graph is a little off. It's saying that the Boise City median sales price is $415,000. And if you follow our channel, we know that that median sales price is actually higher than this. They're saying our affordability is so out of whack, right? Normally you want to see that sitting right around the 35%, but we're sitting at 48.5%. Now, the Twin Falls Metro is actually looking better than it is nationally. According to this Atlanta Fed chart, the Twin Falls Metro is sitting around 39.8%. So it's about 5% higher than what the Fed is hoping that we would stay at, which is right around 35%. Nationally, again, we're at 43%. So Twin Falls is looking a little bit better, but we're still higher than what it needs to be. Let's look at this last thing. What happened to the 10-year treasury? Why and how has this affected the 30-year mortgage? You see, in February, certain people, bankers, realtors, we're all planning on a Fed pivot to come in March. The 10-year started to drop at the beginning of the year, which caused some people to say, we're going to see interest rates hit the low 5% range by spring. But spring is around the corner and interest rates are moving in the opposite direction. We saw some reports come out stronger than expected, which made investors say, oh crap, we need to pivot, and the 10-year started to climb. Investors overlooked the immediate disinflation that was the low-hanging fruit to get rid of from the 8 to the 6%. And in order for us to hit that 2% mark, it's going to take some time. There were bankers, they were banking, no pun intended, on the Fed pivot in March and started celebrating too early. Yesterday, at the time of this video, Chair Powell just opened the door for a 50 basis point hike. Everybody has been planning on a 25 basis point hike or a no hike in March, which means that they could get even more aggressive next week at the meeting. As he testifies before the Senate Banking Committee, he said, if in totality the data were to indicate that the faster tightening is warranted, we are prepared to increase the pace of the rate hikes. So the Fed pivot is possible, but I don't think they were planning on this kind of a pivot. And when asked if he was going to be pushing the unemployment rate up, he stated strong wage growth is good for workers, but only if it's not eroded by inflation. So the question I have for you is inflation hurting you, or would you want the Fed to stop what they're doing and leave inflation at the 5 or 6% range?